All right, guys, I want to welcome you to the December 2025 State of the Market Economic Update. I appreciate y'all being here. Of course, we do this every month to make sure that we can keep you in the loop and in the know on the things that are impacting the housing market so that you can be able to stay on track with your client conversations, make sure that you understand what's impacting what comes ahead, and also just to make sure that you're informed. Gary says become the local economist of choice. And so this call every month is about just really bringing you the key insights, the data, the things that we're watching on the backside to make sure that you are equipped and that you understand what's ahead. And I will say, as we close out 2025 and we look at 2026, it's been a heck of a crazy year. When you look back and you look at some of the trends, you look at where we've been, you look at the just some of the things that have happened from tariffs to nearly 8%, or I'm sorry, above 7% interest rates. You look at presidential elections, just everything that's happened this last year, we're actually sitting in a pretty good spot, to be candid. And it's been a few months since we've said that. So, with that said, I will pull up our slide deck and we will jump into the presentation so we can get moving. Okay, there we go. Of course, I'm Brian Wentz, the operating principal for KW Coastal Living 1 and 2. And I do want to share with you just a quick Echelon Home Loans update. We do have Homer Walton is our newest loan originator that is taking over the as our fearless leader of Echelon. So I do have the iOS, the app up for downloading the Fast Track or the Interlind app for either iOS or Android. And Homer, you're in the audience today. Do you just want to say a quick hello and welcome? You able to come off mute there? There you go.
How you doing today?
Good, good,
Yeah,
good.
I was trying to get this device hooked up and it's not working for some reason today.
I was having the same issue, no issue. Just say hi to everyone if you don't mind, and just give them a 2 second bullet point about yourself.
Hello everyone, and my name's Homer Walton. I've been in the industry for 30 years. I've done just about every type of lending there is that you can imagine. Um, and with that being said, I'm here to help you all out and look forward to building very strong relationships with everyone. And I'm looking forward to this opportunity, and I wish everybody a happy new year and or Merry Christmas and happy holidays and happy new year. So if anybody has any questions or have any need to reach out to me anytime. I'm available 24/7 up until 9 during the weeks. So if you want to call me up till 9, I'm available for any questions you may have.
Awesome, sounds good. We
Okay.
appreciate that.
Thank you.
We welcome aboard. We look forward to welcoming you to the Echelon and the Coastal Living Collection family. So let's get a quick catch up on what's happened over this last month, and it's kind of interesting because it's been a mildly quiet month, and that's an unusual thing. So it's kind of nice to see that. So when we look at just a few bullet points, of course, in December the Fed did cut 25 basis points. So the cut that we were expecting, well, I say that we were expecting, and yet it was a little bit of a question if it was going to happen, did happen. So that was positive. We're starting to see the impact of tariffs on inflation easing. And this is something that we've been watching carefully. Tariffs can be inflationary, and yet those prices have gone up. They've started to settle in, and that's having less of an impact than what was projected. That's a good thing. It's good for the housing market. That also has helped in that inflation is starting to head in the right direction. And when you see the graph of where we've been and where we're at now, it's a little bit shocking. Um, One of the things we're watching really closely is the job market just continues to soften. And some of this is with less immigration and less labor force growth. We have fewer workers coming into and entering into the workforce. Now, That's not a bad thing necessarily. However, a smaller workforce also means less employees, less job growth. And it's been a very unique year for job growth. We just have not seen the kind of growth that you typically would expect to see. And it was kind of odd because 2 months ago at the Fed meeting, Jerome Powell commented that they could see anywhere from zero job growth to 50,000 and still be okay. Now, a typical month would be somewhere between 180 and maybe 240,000 jobs added to the economy. So we're in a little bit of a unique time with that. The 10-year treasury, the secret sauce that drives mortgage rates, has actually stayed very, very calm. It hasn't reacted crazily to anything that's going on in the economy. That's good because we're coming off of a year where it was highly reactive and we saw a lot of fluctuation up and down. That in turn means mortgage rates have been steady, and that's allowed mortgage purchase applications to continue to improve. That means that in the next 30 to 60, 90 days, those are people that will start to go under contract. So that's really good. We, of course, are coming up at the end of Jerome Powell's term, and we are awaiting the president's nomination on who is going to replace Jerome Powell. His term really runs through the end of May. We're not sure if it's going to be Hassett or who it's going to be. If I'm being honest, I really expected we would know going into December, and yet he's held off for whatever reason announcing. Once that announcement is made, basically, it's not that Jerome Powell becomes irrelevant, but it's just that his words have a lot less of an impact on the market. And the new Fed, their commentary, what they say, the markets will hang on those words much more closely. So it'll be kind of interesting to see what happens if that happens in December still, if it happens at the beginning of January, but that's going to be that replacement will be very, very good for housing. Trump's made it clear he wants to put a pro-housing advocate in there. Existing home sales were on the rise. So things are actually improving. We're headed in the right direction after 3.5, almost 4 years of the lowest sales pace in US history. And I'm going to show you some of the numbers and give you a sense of why those numbers are where they are and then what 26 and 27 is looking like. And then lastly, this is a trend that I've been watching really closely that is a little bit fascinating. And I've got some data in here I'm going to talk about. But consumer sentiment about the economy, consumers, even though I just said there's a whole bunch of good things happening, the consumers don't feel it. And we know from experience that the way the consumer feels actually impacts their actions. It impacts the way they behave in the economy. And consumer sentiment oftentimes does lag behind. So as things improve, it takes a while for people to feel like, hey, my pay is getting better, or inflation is coming down, like things cost less at the store. So consumer sentiment, if I was really telling you what you need to know with one bullet point, being able to develop your talking points with your consumers around why it's actually a better time to buy than they think would be an important conversation to work on. So I'm going to share a few graphs and charts that I've assembled over this last month that really relate to this. The first one talks about home buying intentions. So they ask the question, based on what you know right now, do you think you would buy a home in the next year, in the next 5 years, or in the next 10 years, or would you never buy a home at all? The green line is the next 5 years. The black line is the next 10 years, and the blue line is never. Not for the, excuse me, for the foreseeable future. Sorry, I have a frog in my throat, apparently. Well, this is what's interesting about this. In 2013, 45% of respondents, and I believe this was I believe there were 6 questions that were buried in this, but in 2013, 45% of people thought they would buy a home in the next 5 years. In 2017, and of course, that was a really good market that we were in, it was nearly 1 in 2 said, yes, it's a good time to buy, and I plan to buy in the next 5 years. And yet here we are at 2025, and only 3 out of 10 consumers say, hey, I plan to buy a house in the next 5 years. And if we look back at the other side of that, in 2013, it was 22% said it was probably more like a 10-year horizon. 2017, 1 out of 5 said it's going to be a 10-year horizon. And here in 2025, 23% are saying it's going to take them longer than 5 years to be able to purchase a house. And that's an indication, it's just an indication that the consumers, they don't feel comfortable with where rates and affordabilities are. But the one that really just blows the chart out of the water is that 45% of people indicate that they do not see buying a house in the foreseeable future. That is a huge, huge, huge number. And when you look back, it's been as low as 27. So basically 1 out of 4, but almost 1 out of 2 say it's not likely in the future. So interesting statistic. And if we break this down a little bit further, what are the reasons behind this? Well, the number one item is affordability. And we've been talking about this. It's there's a question, is it a are we in a rate lockdown, or are we just in an affordability issue? And the reality is it's a little bit of both. But the number one reason cited for renting rather than owning a home was that they could not afford to buy, or they had a lack of money for the down payment. 45% in 2013, that was their reason. 68% today. It's a huge increase. And if you go down, there's always a permanent renter. So is it more convenient to own? 10% in 2013 said yes, and 11% today. So that number hasn't really changed. 1 out of 10 say I'd just rather not have to go through the process of owning. But citing the poor economy or the housing market as the reason for renting has gone from 4% to 9%. So again, we see a lot of people that are just they're not feeling it. They're not feeling it in the marketplace. The one other thing that I thought was interesting, that in 2013, we were still coming a little bit out of the 2008 housing crisis. 12% said bad credit, bankruptcy, or a lack of financial stability. And yet only 6% today say that. So they feel better about their incomes and their financial affairs. However, they just don't feel good buying in this market. Now, if we look at this, and it's funny, this graph kind of looks like the previous one, and yet it's a completely different graph. It's asking, is it a good time to buy? Is it a bad time to buy? In this case, the previous graph talked about, and I'm getting a little feedback. McKenna, will you just double check and make sure that I don't need to mute anyone? This graph talks about, is it a good time to buy? Is it a bad time to buy? In 1978, now this is where I want you to think about this. In 1978, 53% of respondents said it was a good time to buy a house. Interest rates at that point were in the 10.5, headed up to 13% interest rate range. Now we're at 6.25 today. And yet 1978, 53% said it was a good time to buy. In 2003, 81% said it was a good time to buy. 2008, after the financial crisis, or right in the middle of the financial crisis, 53% said it was a good time to buy a house. And yet when you look at today, only 26% of respondents think it's a good time to purchase. And when you flip that on its head and you say, okay, well, who thinks it's a bad time? In 1979, when interest rates hit 12.9%, 28%, 1 out of 3, thought it was a bad time to buy. But when you carry that over today, 72% of respondents think it's a bad time to buy a house. And if you go back 2 years ago to 2023, when interest rates hit almost 8%, it was 78%. This is the challenge that we're dealing with. It's that consumer perception, the story in the media, just some of it's reality, some of it's just perception. But this is where we have to equip and arm ourselves with the tools to be able to overcome this. This is one other survey. This is the Fannie Mae Home Purchase Sentiment Index. This one also asks a multitude of questions and then amalgamates it into a score. And when you look at this, August of 2011, so going back as far as the survey goes, the low point of the survey was 59.3. And again, that we were coming out of the 2008 recovery. For those of you who were in the industry at that point, 2008 through 2011, a little bit of a rough time. Inventory was off the chart. Rates weren't terrible, but we had a lot of homeowners that had lost homes in short sales. It was just a unique time. When you carry that forward, by 2012, they were at 71.8. Headed into the the pandemic, so the pre-pandemic confidence level was at 92.5%. That's a historic high for this survey. And of course, we entered into into a worldwide shutdown and everything happened. Guess what? 2 months later, we're sitting at 63. Now, October of 2022, this survey hit 56.7, and that was after the fastest increase in interest rates in US history. And yet today we're sitting at 71. So despite the fact that inventory is returned, inflation's under control, wage growth is wages are growing again. Rates are at 6%, historically below average rates. We still haven't returned to that confidence level that says, hey, this is the right next move for me. And when we look at this on a regional level, it shows a very similar story. And so I've highlighted here the Southeast region. The first blue says that homeowners are very, very concerned about housing affordability in their markets. The light blue says they're somewhat concerned. The kind of gold color says somewhat concerned. And the last little tiny bit over there says, hey, I'm not worried about it. Well, when you look at our Southeast region where we reside, 98% indicated they have concern about affordability in their market. So again, this paints that story that when we look at what's happened with real wage growth and appreciation, and of course, interest rates, we just have an affordability issue that continues to show up here. Now, we go to the next slide. This was an interesting one. At what rate would be the highest mortgage rate that a homeowner said they would accept on their next purchase? We know from experience that when we get duration, in other words, when interest rates get between about 6.4 and 6 or lower, and we get that for about 13 weeks or an extended period of time, we get what we call duration. We get mortgage purchase applications will start to pick up. And it's interesting because this chart actually, even though this is current data and I'm talking about historical data, this chart really illustrates this. So when given the choice, if you had an opportunity to do a mortgage under 4%, 100% of people said, yep, I'd take that. And by the way, they took out the 10% who said they never plan to sell and the 10% who said they'd pay cash. So these are actually people who would go take a mortgage. 100%, hey, I'll take under 4. Under 4.5%, 88% said, yep, I'll take that. Under 5, 78% said I would take under 5. But I think that's an interesting statistic because that means almost 1 out of 4 thought 5% was still a bad rate to be able to take. Now, that's where you've got people that are just have become accustomed to a 2.875 or a 3.5 rate. When we go to 5.5, 54%, so about 1 out of 2 said, hey, I'd take a rate at that or less. 41% at 6%. But notice what happens between 6 and 6.5%. We go from 41% to 26%. And I noted that move from 6.5 to 6, that's a 58% increase in their willingness to take a mortgage at 6, where they would not at 6.5. And of course, we've been toggling in that 6 and an 8, 6.3, 3.75 interest rate range. So we're right in the middle of that. And that's why so much of the conversation around mortgage rates, the 10-year treasury, mortgage spreads, it's why it affects what we do at such a high level. When you go up from there, at 7%, only 16% said that they felt good at taking that rate or less. And at 7.5 or higher, there were still 7% that said, yeah, I'd do that. And this is my personal opinion. Those are probably people that lived through a 12, 14, 16% era and said, yeah, 7's still a really good rate historically, which by the way, it is. I do remember when I was in real estate in the 90s that we threw a party when rates went from 10 to 9.875% because we were in the single digits. So we're living in unique times, but I think this is an important one just to pay attention to. And the last one, and this was the one that really hit hard on consumer sentiment. The Michigan Survey of Home Buyer Sentiment. In their survey, and Jason Abrams talked about this one at his roadshow this last month in Orlando, only 16% of Americans said today is a good time to buy. And to put that in perspective, more people thought it was a better time to buy during the dot-com era crash in the 2000s during the 9/11 time frame, and they thought it was better time to buy during the pandemic. So the world was collapsing around us, and they said it's a better time to buy a house than today. The only times that we've been comparable to this level was in 1966, when the Vietnam War was raging on, and in 1981, when interest rates hit 19% and we were having an oil crisis, or we were coming just off the tail end of the oil crisis. And then lastly, the 2008 housing collapse. Now, those three elements historically, those are massive events. Those are red letter timeframes in our history. We're not experiencing these types of issues today. And yet, again, consumer sentiment says, I don't feel so good. Only 16% feel like it's good. So it's going to take a little bit of time for those consumers to start to realize what's going on. And again, I will tell you, this is where your commentary, your social media, your communication with your database, this is where it matters. You can actually create energy and synergy where maybe there's a little bit of lack of consumer engagement. Now, as we look at this, just to kind of put the mortgage rate lock in, and I'm not a huge mortgage rate lock in person. I do think it's an affordability issue, but there is a reality that if someone has a 3.5% interest rate mortgage, to buy unless they have to means that they're going to spend a lot more money, especially when rates were at 7.5%. So currently about 30% of mortgages of homeowners so of those that have mortgages, about 30% have rates below 3%. So that's still a big percentage. About 40% have rates between that 3 and roughly 5% range. And only about a third have rates above 5. There's a very small little group, we're going to talk about that next, that do have rates that are in that 6 and 6+ range. So that means that 7 out of 10 homeowners would have to either give up a sub 5% interest rate in order to make a move. They'd have to double or more increase in their interest rates, or they would just have to be okay with just their payment just going up. So this is where the reality meets the marketplace. Now, here's a couple of things, though, that it's important to remember that mortgage rate lock-ins, when we've experienced this in the past, they decay over time. And the further we get from those low rates, the less of an impact that they have, because life events happen. So every year, divorce happens, kids grow up, they graduate, parents age, job changes, health changes. There comes a point in time where the rate just becomes moot, because the quality of life, the need, there's something else necessitating that move. And I think that this is where we're positioned right now, with where rates are, with what 2026 is shaping up to look like. I think we're at a spot where the confluence of all of these are going to make for a much better 2026 than we've had the last 2 or 3 years. Here's what happens. New buyers enter at higher rates, and then they normalize those higher rates. So when we look back between 2023 and 2025, and of course, June of 2022 is when the rates just really started to shoot up. So if we just take 23, 24, and 25, we have about 12.7 million homeowners that have taken loans that are in that 6 to 7% range. These are people that are future move-up sellers. They're not locked in. They probably will be refi opportunities at some point. But this is why 26 and 27 sales growth is expected to still go up, even without those super low interest rates. And I made a note here that lock-in rate is always strongest right after the rate spikes, but weakens in future years. So to put a bow tie on the rate lock conversation, the market doesn't need everyone to move. It really only needs the marginal seller, the life event seller, or the rate tolerant seller, that person that can afford the payment. And that gives us more than enough units and volume to keep us very happy. Now, Fannie Mae is forecasting it was a 7.8% growth in existing home sales for 26. And I thought it was interesting they had the exact same forecast for 27, so about 7.8%. There are a couple of other forecasts that are a little bit more in the 5% next year and 6.5% the following year, but pretty much without fail, every single growth estimate is showing that 26 is going to be better than 25 and that 27 is going to be better than 26. So the message there is hang in there. We're moving into a better market. We've got an increase in sales on the horizon. So if we kind of bring this back to where rates are today, currently today, 30-year fixed rates about 6.25-ish, 6.25. Your 15 years are about 5.75. And of course, you can get better rates than this by how we price the loan. Homer can help with that. Jumbos are running about 6.5-ish. And then you've got FHA and still in that sub 5 range and VA in this sub 5 range. So when we look at this historically, these are actually pretty darn good rates. So let's put this into perspective. And this is a 3-year look back at what's happened with rates. And this is under two headings: one, closing out the year and understanding where we've been, and then putting it in perspective of where have we been the last through this crazy pandemic era. And as I was preparing for this month's presentation, I was specifically struck by the number of one-time events, the number of one-time economic events that have happened just in the last 5 years. And you look back, some people have lived 60 or 70 years and, maybe had one or two one-time events. We've had like 20 in the last 5 years. So currently we're sitting at about 6.25. We did hit the low in October of the year of 6.17%. And that's, of course, off the high starting the start of this year at 7%. And if you guys remember, it was a rough start to the year. Rates were high. Affordability was tough. When we look back to 2023, October 2023, that's when spreads were terrible and when the bond market hit a really, really high point. So those rates were almost 8%, and that's when affordability just shut down. And of course, we know 23 was a pretty rough year. If we look back a little bit further, the last slide was 3 years. This is 5 years. You start to get a sense of where that affordability challenge has happened, especially when you factor in appreciation into this. So September of 2020, 2.9% interest rates. Boy, long gone are those days. And yet you can see that steep mountainous climb that we've been through. And yet we're starting to level off. Things are starting to stay a little more stable getting into this 2025 range. June of 2022, 5.8. And then of course we shot up to 7 and almost 8%. It's been a rough ride, When we look at this in a historical perspective to understand what's normal, anything below that roughly 8% has actually historically been below average. So we're at 6. We're actually in a good spot. I think that's a message that consumers need to hear. And of course, when you look back to the 80s, we were coming off the oil crisis. We had inflation that was off the chart, and interest rates were at 18.6%. But people still bought and sold homes. They just did it with a lot of points paid by the seller to make it happen. Wage growth is something we haven't talked a lot about for a few months. We've been tracking the last 5 years. What has wage growth looked like, and what has the appreciation rate looked like? And in a few months back, probably 6-8 months ago, over the last 5 years, we had about 14% real wage growth, and appreciation was 49%. So that gave you a sense of how much of a delta there was between how much everything cost and how much income people had. September, we've got some good news on this. We were sitting at 5.01% year over year wage growth. So that means consumers are making about 5% more in their actual wages than they were last year. 6.16 is the long-term average from the 60s until, from the 60s until 2025. So we're getting a little bit closer back to that long-term average. And here's the most important thing. And actually the president in his speech talked about this last night. We're back to a point where wages are growing faster than inflation. And that's really important. And I'll talk to you why here in a moment on a slide that I have. So if we look at this is what wage growth has looked like over the last year. These are very small differences, by the way. So when you see, it kind of looks like October and November, things were really big. These are incremental 0.1% differences. But you can see we're starting to level off. And when we look at this on a historic level, this is an indication over the last 5 years, not historic, but 5 years. We had an all-time high in April of 2021 of 15.5%. So real income or wage growth went up 15% during that period of time. Now, you start to see it's become pretty steady. And when you compare this against inflation, which we'll look at in a minute, you start to get a sense of how we're starting to get back to a healthier market where people are making more money, costs are going up at less than the income, and that gives people the ability to afford more house, go do things, spend, and that of course drives the economy. Now, this is interesting. I talked about those one-time events. If we look at wage growth over the last 10 years, April of 2020, we saw a negative 6.1% wage growth. So wages actually went backwards during the pandemic. People were concerned about income and keeping businesses alive. So they cut back on salaries and hourly wages. This is a historic period. So we also have a historic period that preceded that or that post-dated that. So we have two historic numbers, two all-time highs that are all pandemic related. So I did update this slide this month over the last 5 years. So this month, going back 5 years, the average appreciation of a U.S. home has been 55%. I want you to think about that. We all know it's the case. Homes just cost more, but we've gone up almost half again as much. The average wage growth is starting to catch back up with that. So we're at a 30% average wage growth, but that still means with higher interest rates, higher at median sales prices, our wages haven't quite caught up. And this is where consumers just feel that pinch. And that's why we saw some of the data at the top side of the presentation. Now, I call this the homeowner wealth factory. And this is when everything is working the way it's supposed to, and I share this so that you have a perspective on this. When everything's happening the way it's supposed to, this is the magic of home ownership. And if I'm being frank, this is the magic of what we do in our industry. And it's this: when wages grow faster than inflation. So if inflation's at 2% and wage growth is at 6%, that means every year consumers just have more to spend, more disposable income. They have more money to spend on new things. Homes then appreciate at a rate above inflation, traditionally in that 3.5% to 4% range. So the value of your home goes up every year. You make more money, your values go up. And then this is the key. Your mortgage debt is fixed. The inflation erodes the real cost of that debt, meaning that mortgages are a great hedge against inflation because you lock in your cost for 30 years. And we're the only country in the world that has the 30-year mortgage, and we are the envy of the world. Of course, Canada is probably our closest similar product, and yet their loans adjust every 5 years. So every 5 years, there's a rate adjustment. We're locked in for 30 years. That payment, aside from taxes and insurance, the payment stays the same. That means equity compounds over time, and that's where we get wealth creation through the ownership of real estate. And of course, that is what the government wants to have happen, is they want people to buy houses and create wealth. Which takes us to employment. Employment's a key factor, and this is one of the things that's starting to become a little bit of a yellow light on the dashboard of the economy. Non-farm payroll, October, we actually went backwards. We lost 105,000 jobs. Now, this data is amassed by the Bureau of the BLS, the Bureau of Labor Statistics. It's a mouthful. They have a very inaccurate process, which is why we see a lot of revisions. We see these numbers go up and then they get revised down. And so it's a little bit of a moving target in how they report this. However, in November, it did show a gain of 64,000 jobs. If we were talking 5 or 10 years ago, 64,000 would be a horrible number. Today, the economy is going, well, it's not that bad because we don't have as much new workers entering the workforce. It's interesting that most of the new jobs gained this year are from healthcare. So people are getting older, they need additional medical care, and the healthcare sector is growing. And construction, and a lot of that construction I noted is AI data centers. The AI data center boom is really driving part of the economy, and and keeping the construction markets active. If we look at this, you can kind of see on the 3-year chart, you can see where we're starting to have some softness in the economic data. And typically the Fed looks at labor data over inflation. So they care about inflation. They want to keep inflation at 2%. They want to keep labor at maximum employment. But when labor starts to break, which typically means that we're at 5% unemployment, or we get weekly jobless claims that are over about a 280, 315,000 range, that's when they start to get concerned and they start to get a little bit more dovish or accommodative in their policy stance. So the fact that we've had 3 months this year that we've gone backwards, that's a yellow light, and we're watching that really closely. And yet, when you look at this coming off the pandemic highs, you see we've really improved in our unemployment numbers. So we went through some pretty rough times. And I thought I had another graph in here, and I don't have that one. But when you look at this on a historic level, we're starting to get up there a little bit. So we'll watch that a little bit closer. Next thing we watch is inflation, and you guys have heard a lot about that because we've had a couple of years of 8-9% inflation, and we all feel that when we go to the grocery store and we buy a little bag of groceries, and it is a price. It's a pricey endeavor. In November, core CPI, which is the consumer price index, which is just a measure of how much a bag of goods costs that we track month over month. Core CPI was up 2.6%. The expectation was 3.1, so we beat expectations, and that was a very positive thing. This is a sign that inflation is getting under control, and rates, the increase in costs, they're starting to come down. Now, food and energy are two parts of the economy that can vary wildly. So we've talked about this in past months. Core CPI takes those out. If we put those back in and just call it CPI, we actually ended up with the same number, 2.7%. And again, we were expecting 3.1. So this is good news. We're headed in the right direction. And this is actually very, very good news for the housing sector. The other part of this I noted is that tariff impacted goods we saw in when we hit Liberation Day, April of this year, April 18th. Liberation Day, we saw a lot of goods start to become tariffed, and the impact of that has kind of settled in. And so we're not seeing that in the inflationary numbers as much as we were. The one wild card on that is if some of the tariffs do get struck down, those costs would probably go back down. That's unusual that costs go down, and that would actually be beneficial for the inflation number, but we're not in a bad spot right now. If we look at inflation historically over the last couple of years, this is a 3-year time horizon, you can see where we're starting to get under control. In November 2022, we were at 6%. And at that point, wage growth was only 5.1%. So things were actually costing more than people were making. And that's where we kind of went backwards in our earnings potential. If we zoom out, we look at this on a 10-year, this really gives you a sense of where we've been. You can kind of see that pre-COVID, we were kind of steady in the inflation rate. And of course, we printed a lot of money. We took a lot of measures to prop the economy up, and that's what created that high inflationary time. So you can see through that 21, 22, 23, those numbers, and where we're falling back off, and now we're starting to flatten out. Again, this is good news. This sets 2026 up for some good things. We look at unemployment. Unemployment in November was 4.6%, and it was forecasted to be 4.5 to 4.6 next year. So we're sitting at a pretty good spot. And if we just look at this, you can see where that unemployment is continuing to grow a little bit, and yet we're not terrible. Again, anything under 5 is still considered to be good. I show this graph just to be able to give you a sense of where we've been, because zooming out really starts to let the trend be visible. You can see through the 2015 through 2020 range, unemployment was very good, very steady. We of course had the COVID lockdown. We had 14.9%. So if you think about that, 15 out of every 100 people were unemployed during that period of time. We've subsided, but if you notice from 23 to 25, that trend line is trending upward, and that's where we're watching that closely to make sure that the labor data doesn't break. One of the other factors that we look at is the 10-year Treasury. The 10-year Treasury, of course, is the thing that drives interest rates at the end of the day. We've been in a really steady range, 3.9 to 4.2. The markets were pricing in a 25 a quarter point cut in December. We got it. There was no surprises. There was not a lot of surprise in the mortgage markets or in the 10-year Treasury. Currently, when we look ahead, I looked today, Polymarket has a 26.6% likelihood. So 1 out of 4 that we would see another rate cut of 25 basis points in January, but it was up to a 60% likelihood in March. So again, that will help. That will keep spurring the economy on, and that would be very good for housing. We look at this, not a lot of movement over the last 1 year or over the last, I should say, 2 to 3 months in that 10-year Treasury. But this is the number that we look at. Again, this affects mortgage rates. And when we look back, when we had super low mortgage rates in 2020, the 10-year Treasury was at 0.5%. That is just staggering. That was an indication that there was very little confidence in the economy. You can see that we hit 4.9% in 2023, and that's that point where we started to see with mortgage spreads almost 8% rates, and you can see where we've kind of settled back into that 4 range. It's really important to know that between about 3.8 and 4.2, that's a normal trading range in an economy that is healthy. It's not like blowing up with growth, and it's also not imploding with economic scares. To get below 3.8, there has to be some recessionary thing. There has to be something happening that the economy is concerned about the future. So we're in a spot where we're not going to probably go a whole lot lower, but we could trend down with mortgage spreads, which brings us to the next point. We talk a lot about mortgage spreads so you understand what impacts the actual interest rate itself. And again, historically, there's this slow dance between the 10-year Treasury and where 30-year rates are. Traditionally, there's about 1.5 to 1.75% difference in those rates. But understanding that when we talk about Fed rate cuts don't directly impact mortgage rates. There's correlation, but it's not causation to rates going up or down. And this is what I call the slow dance. You'll see on this, the gray line is when the Federal Reserve increases or decreases what they call the federal funds rate. And that's what we hear in December, it was 25 basis points. The Fed cut rates. Well, you see that line goes up and down a little bit differently than the blue line, which is your 30-year fixed rate, and the red line, which is your 10-year Treasury. And you'll just kind of notice that the 10-year and the 30-year, they just kind of dance together. Sometimes they dance a little closer. That means the spreads are smaller. Sometimes they dance a little further apart. That means the spreads are worse. When there's concern about the market or the mortgage markets or something like that, the spreads get worse. When you can see what's coming at you, the spreads get better. So today we're at 4.1 on the 10-year Treasury. 30-year fix is about 6.27. Means we're sitting a little over 2% for the spread. So we're a little high. What that means is if with clear forward guidance of what's happening, in other words, we understand what's happening with tariffs, we understand what's happening where inflation's headed, where unemployment's headed, we don't have a fear of war or anything that's major pending out there, those spreads could get back to that 1.5 to 1.7 range, which without anything else happening in the economy would put us at 5.675 or 5.875 on a 30-year fixed rate. And if you remember, that was a major inflection point where a lot of people said, hey, I will get in the mortgage markets at that point. I'll buy or move. Just to get a sense of where we started the year, we were at 7.125. That meant that the principal and interest on a median priced home at 20% down was 24.48. Today it's 21.94. That means it's a 10.4% savings, or that the average buyer can afford about $50,000 more home than they could at the beginning of the year. So either way you cut it, we're moving in the right direction. A couple of last things I have for you on this. U.S. home sales, existing home sales. In the US, there's about 92 million total existing homes. Now, we add to that housing stock every year with new construction that ages out and becomes existing in the next year. But if we know that about 5 to 6% of homes will transact in any given year, that means that our typical range is about 4.5 million to about 6 million per year. The challenge is we've been running at 3.9 to 4.1 million for the last 3 years. This has been an absolute floor. In other words, it just doesn't get worse than this. And that's where, when I say the last 3.5 years, when you adjust for population growth, it's been the lowest sales pace in US history. So for those of you who've gotten in the business the last couple of years, or for those that just felt like it's been hard, it's because it has actually never been harder historically than the market that you're in right now. We feel it. We know you feel it. Hang in there. There's a light at the end of the tunnel. And I made a note in here that demand didn't disappear. It's just that participation is suppressed. People are just sitting on the sidelines. If we look at this over the last couple of years, it's a 5-year look back. You can see we had a high in January of 2021 of 6.66 million home sales. And you can see since then how we've fallen off, and we've been in that 3.9 to 4.1. We just really haven't. You got a little bit of seasonality in there in the summer months when the rest of the country picks up, but we've been scraping the bottom. So where are we headed in 26? Let's just talk a little bit about a few bullet points. The first half of 26 is starting to shape up to be a lot better than the second half of 25. So that's the good news. Rates, we don't expect rates to move a lot. We're expecting them to be somewhere in that 6.25, 6.125 range, which again, with duration, will pull people off the sidelines. The second half of the year, though, we're expecting to see a couple of rate cuts. We're expecting to see a little bit of a return to more normal spreads. So it's likely that we'll bookmark the second half of the year with more of a 5.5 to 5.875. And again, if you remember the slide earlier, 5.5 pulled a lot of people off the sidelines. This, of course, assumes no surprises, that inflation continues to cool, that the job market continues on its path and doesn't break, and that we figure out what's going on with tariffs. So what does this look like for this year? We're expected to finish this year just under 4.1 total sales, 4.06 million. 2026, I took a couple of different forecasts and put them together, but everything I was seeing was about 4.4 to 4.5. That would actually be a 9% increase. So that's a pretty big jump. But we're coming from a historic low. So, 9% on a historic low is, we have to be careful using percentages. 27 would be another 6.1% increase, 4.7 million. And I said earlier that Fannie Mae was predicting 7.8 for both years. So we're expecting to see more home sales. We bring this down into just the local markets and we take a look at Charlotte County. Currently, the pending home sales are above 2022 and 2023 levels. And of course, I will send these slides out to you after, so you have these. But you can see the last couple of years, 2022, of course, June of 2022, right in here. This is when rates hit the crazy high rates and things started to shift. But we're going to finish the year in not a bad spot considering these last 4 years. We're trending above. Charlotte County demand is starting to stabilize. We're running above 22, 24 levels, even with mortgage rates elevated. For sellers, they still need to price aggressively if they want action, and especially the condo market. But buyers do have some negotiation room, especially with longer days on the market. So the time on the market matters. We come down to Sarasota County, we look at pendings. Sarasota County is running above 22, 23, and 24 levels. So this is a positive sign. You do see the seasonality that happens through that April, May, June. You get a sense of where where those transactions start to go pending at. This is good news. Sarasota County pendings have stabilized. They're running above 22, 23, 24 levels. Buyer demand is holding even in this little slightly higher rate interest rate. So for buyers, buying now means less competition, more negotiation leverage than you're likely to have as rates ease and more buyers return to the market. For sellers, homes that are overpriced, homes that are priced realistically, they're selling, but sellers who overprice are seeing longer days on the market and more buyer pushback. And Leslie has a question in there, so let me take a peek at that. Do you think the pendings being higher is because of no hurricanes? Leslie, that's a really good point. Actually, yes. a quiet year probably brought more people into the marketplace. I know that where I live, there's 4,000 residents on our island for most of the year, and we go to about 22,000 in season. And I know people definitely got here earlier this year than they did last year. So I think that's a valid point. Manatee County. Manatee's a little bit interesting, and I think this is a little bit of the heavy new construction impact in Manatee County because new construction and single family or existing home sales, we don't cross those two streams. They really march to their own beats. And in this case, the pending home sales were above 2024, but we're still below 22 and 23. I made a note here, Manatee County sales are stabilizing. It is indicating buyer demand is firming even as the market remains price sensitive. For buyers, they still have negotiating leverage, but that leverage narrows quickly on well-priced homes as demand continues to firm. So again, when we price it right, the sellers get higher price or closer to list, and they get it in a lot faster time. For sellers, homes that are priced realistically are still attracting buyers, while overpriced listings are seeing longer days on the market and multiple price reductions. We do call this the money slide. I did not have a chance to update this one this month, but this gives you a sense with a seller that says, hey, let's try it higher. When we look at this is the Tri-County area. Homes that are listed and priced right out of the chute are selling for an average of 95% sale price to the original price, and they're selling at an average of 29 days. So where some of our days on the market is getting into the 160, 180 days, if you price it right, there's still buyers out there and it still sells in less than a month. If you overprice and miss the market, we're selling on an average of 85% sales price to original price, and it's taking on average 141. And I would bet you if I did the data, I'd bet it's closer to 150 days on the markets this month. So this is where pricing right matters. If you miss the mark, you've got to adjust quickly and don't let those things become market stale and just sit there. So if we go through a little bit of national housing data, just to give you the big picture, and I'll give you a couple of local items to think about. We are still in a slight seller's advantage across the U.S. with the median list prices at 422,000. If we just compare, the reason it's important to understand where we are sitting at nationally with housing inventory is it gives us a sense of, are we in a savagely unhealthy market, or are we in a more of a healing market? And the good news, the silver lining, and everything that we've been through the last couple of years is that inventory growth or homes for sale has gone up. That's healthy. That means we're setting ourselves up for a better recovery as things stabilize. So we're sitting at about 775,000 homes on the market. That is actually down 7.6%. So that's an indication that people are pulling things off the market around the US as they head into the cooler winter months. Condos, the median price in the US is 369. It's still a little bit of a seller's market, not much in the US. And there are 211,000 condos on the market in the US. That number is also down 5.7% over last month. This is one of the slides to pay careful attention to. I'm going to move this out of the way here. This is let's go back. This is our US housing market, our total listing inventory trends. And you'll see that in March of 2022, we had that savagely unhealthy number of 240,000. Historically, we have anywhere from about 1.2 to 1.4 million existing homes on the market at any given time. That number is why we saw 30 offers and massive run-ups, and especially when coupled with low interest rates, that's just where that was not a sustainable market. So you see the seasonality trends. You can see that we've kind of peaked out a little bit in that July, August, September timeframe, which is normal in the US. We're sitting at 775,000. We're about 60% under historical levels. And I'll tell you about the Goldilocks effect here in a minute. We look at days on market in the US. Currently, it's about 125 days to sell a home, up from the low of 54 days in 2022. We look at price decreases. Typically in a healthy market, you see about 34% of homes having taken a price decrease. We're sitting at 40%, so we're still running a little bit higher than typical, and that's an indication that in the U.S. sellers are overshooting a little bit. In other words, they think the slope of the trend line is higher than it is, and they have to get a little bit more realistic at the list price. We look at the percentage relisted. We're sitting at about 10% relist. That's a pretty typical number, so pretty healthy market in terms of relisting. And then if we just look at median list price, we break these down into the four tranches: lower 25, middle, upper 25, and then the top range. You can kind of see the sensitivity that the lower range has versus the upper range to list price fluctuations. So during the busier months, the upper tier has a tendency to price a little higher versus your lower tiers. If we bring this down into Florida, we just look at how's the state of Florida doing. Right now, we are a little bit in a seller's market. The median list price in Florida, 485, with the average days on the market, 146. If we break this down, this month over last month, there is 3.6% less inventory. If this was July and we were seeing this number, I'd be concerned. With where we are right at the moment, this is actually not a bad thing. I'll tell you why in a moment. I did look up right now. This represents 8% of all U.S. inventory in the resale market, in the single-family non-condo market, and Florida has 6.25% of the housing stock that is non-condo housing stock. So we've got a little bit of a disproportionate percentage of our inventory on the market, but we are so much better than we were in May, June, and July that it's not even for real. So again, we're seeing improvements. Condo market, a little softer. We are in buyer territory there. 345 is the median list price of a condo in the state of Florida, and it's taking 182 days on average to sell. We take a look at this. The condo market, we're flat month over month. We were 65,600 last month, 65,200 this month. It's statistically the same. So that condo market is still sitting there. And of course, we're impacted by Keystone inspection costs, association due increases as a result of that, insurance increases. There's just a lot of things that are affecting that condo market still. So if we look at pendings for Florida statewide, we're actually trending above it says above 24, but we're actually above 2022 and 2023 levels. So Florida's still making progress. We bring this down to the local level, starting down in Charlotte County. Charlotte County is buyer's territory right now. Median list price of a single family home non-condo, 419. We'll go through some days on the market. If we look at the condo market, again, very much in buyer territory. Median list price 275 down there with 193 days. So that's longer than 6 months to sell a condo in Charlotte County currently. If we take a look at single family non-condo inventory, we're at 2,815. And again, I've left some of these historical references on here just so you can look back. But June of 2021, we only had 282 homes to be able to show versus 2,800. That's a 10x increase in inventory. Average days on the market, 177, up from that low in June of 22 of 39 days. Median list price. I noticed this trend across all three counties. You'll start to see that median list price has started to, the slope of the curve has started to level out. So things are starting to settle into a more normal trend line. We're at 419,000 median list price, down from 529 in 2022. We're at 38% of listings have taken a price reduction, so we're a little over the long-term average. And this is interesting in that the Charlotte County, the upper end has clearly become a little bit more price and rate sensitive. You don't see the big fluctuations or seasonality in the pricing in Charlotte County. So your median list price trends down there are actually all falling. All four tranches are pretty similar. We look at price decreases. Of course, the top 90-day are actually taking, there's a Smaller percentage taking price reduction. That's an indication that a lot more cash buyers operate in that price point. And of course, your lower tier is where you see a little bit more price reductions, which is a little more of an indicator that those buyers are price sensitive. We pop up to Sarasota County. We are in slight seller's advantage here still. The median list price is 545 and it's taken about 150 days on the market. So about a month less than Charlotte County. We look at condos. We're still in buyer territory for condos with a median list price of 399 and an average days on the market of 142, notably less. So I thought that was interesting. So condos in Sarasota are still moving a little bit faster. If we look at inventory, we have come off that seasonal peak earlier in the year, which I believe was July of this last year. We're sitting at 3,100 total active units, up from that super low of 328 in 2022. It's funny how you just see how crazy of a year 2022 was. Average days on the market's 149, up from that low of 37. We look at median list price. Again, you start to see it's stabilized. You did see a little bit of a pop through that December 2024 to June of 2025, and that's as rates were falling. You saw people starting to come off the sidelines, be a little more aggressive with pricing, and yet it's if you follow that trend line from about June of 23, there it hasn't been a lot of change. Price reductions, we're sitting at 41% in Sarasota County, so we are a little bit higher. So it's the indicator that sellers are moving down on pricing as they need to. And again, you do see a little bit of a difference in that luxury market or that upper end luxury market where the seasonality is allowing a little more price fluctuation, where that more entry level $319,000 home is a little bit more sensitive to pricing. Price decreases, the bottom tier. So the bottom tier is about 1 out of 2 has taken a price reduction, where the upper tier about 1 out of 3. So you can kind of follow those. These are important depending on what price point you're listing in these counties. You can kind of look at and see where is your competition and where's that trend been. We pop up to Manatee County and we look at this. We're at 572,000 median list price with slight seller's advantage. It's taking 132 days for a home to sell up here. We look at the condo market again, a little bit of buyer advantage. 299 is the median list price. It is interesting that it is going up again. We are 149 days on the market average. If we just look at existing inventory, about 23 homes available for sale. Now, Altos data tracks every home available in every market every single day. It does strip out anything that is like new construction that can't be bought for a long period of time, or something that just is unusual. So these are real numbers, and you'll see these numbers vary from realtor.com, because realtor.com does pile everything in, NAR piles everything into the one data set. This is why I like Altos data. Average days on the market is climbing 131 days in Manatee County. Median list price, again, you see that stabilization, that trend line that's becoming a little more consistent at 572, down from that 857 in 2022. Properties with price decreases, Manatee County, 1 out of 2. They're taking a price reduction. So that's an indicator that there's a little bit of additional softness in that market, or there's just overpricing happening. And again, we've broken the median list price out into the tranches so that you can see where your property falls at your listing. Price decreases. The top tier is the least amount of price reductions, with your other 3 tranches seeing a little bit more activity in price reduction. So the upper end, not surprisingly, is holding a little firmer. The lower price range is a little more sensitivity to taking price reductions. So with that said, I'm gonna stop my share, and I'll share this with you. This is my perception of where we're headed with interest rates that are seeming like we're going to be in a better spot for 2026. We have had an entire group of sellers the last half of the year that have taken their home off the market. When I said the Goldilocks effect, which would be, not too hot, not too cool, just right in 2026, as we see those sellers that re-enter the market in 2026, they will bring another house to the market. And because about 80% of home buyers have a home to sell, that means those folks will bring in inventory to the market and they will buy up. That would accelerate our pace of sales in 2026, and where we have a pretty healthy level, 775 to 800,000 existing homes on the market, we're setting ourselves up for a really, really good 26. So my message to you as you close out the year is get close to your database, make sure you're communicating where rates are, make sure you're communicating that it is actually a good time to buy, particularly before rates fall further and we get a whole flood of buyers coming back into the market. Because next year, as rates come down, as more listings come on the market, as those sellers become buyers, you might get into a little bit more of a competitive situation. And remembering that you can always marry the house and date the rate, you can always refinance that rate down the road. But being able to lock in at a time where you get really good seller negotiations, you get the opportunity to ask for rate buy downs. You instead of price reductions, you can still do a 2-1 buy down or a 3-2-1 buy down. With a 3-2-1 buy down, you can still get rates in the 3.5 or below range for the first year. So use the market to your advantage, but communicate with your database what good is happening in the economy and in this market, because there's a lot of good happening, and it's clear from the consumer sentiment that they just don't feel it yet. So be the voice of our industry. And I thank you. This closes out another year of economic updates. I always appreciate your time. And before I let you go, I just thought I'd open it up. Any questions, concerns, curiosities, excitements, anything that someone wants to ask before we call it a wrap?
I always have a question.
Go for it, Lori.
First and foremost, thank you so much. It was incredibly informative. I learned a lot as I do in all the state of the markets, but this one hit a little bit different. So thank you for all you do for us.
You
I
bet.
have a mortgage question for Homer, and maybe he would be willing to talk to all agents about it. So I'm learning that there's obviously a difference between a mortgage lender and a mortgage broker. And I've been asked by a client, like, what's the difference? And I don't have that answer. I also don't know, like, the difference between jumbo loans and all the other tips and tricks that brokers have that lenders don't have. So I guess my question is if Homer can maybe sit down with some of us that might have those questions.
Yeah, we absolutely can do that, and he'd be happy to. And I'll field that one really quickly for you, Lori. So I guess the best way to put it is going to a mortgage lender is like walking into a little bodega on the corner. They've got they've got stuff that you want to buy, but they have limited inventory. They don't have a lot of options. So they may not have 15 different kinds of cheese that you want. Going to a mortgage broker is a little bit like going to a massive supermarket. You have tons of options, you have tons of things you can choose from, you've got tons of ways you can put it in your cart. And a mortgage broker just allows you to shop a broader range of products and have a broader range of options. I always say it's kind of like the other way I've said this in the past is it's like going to a restaurant and having a very limited prefix menu or having a buffet. I'm not a buffet guy, so I probably would go for the prefix in the menu restaurant scenario. But at a buffet, you've got a whole bunch of other options, and you can slice and dice things the way you want to. So that broker, they just have a wider range of products and a little bit more opportunities, and there's benefits to both. So it's what's right for the client.
The
Oh,
pricing can be a lot better as well, because when you have the opportunity to shop that rate amongst a whole bunch of different lenders, it can be substantially better than if you go to just a retail lender who at times could be better, if they're pulling money down, and offering, because I've seen Wells Fargo do that. But, when Wells Fargo does that, sometimes they're slammed and they're just trying to get the paper in, and you could be
yeah.
waiting 90 days just to get a loan to the table, and it frustrates a client, it frustrates you, and doesn't look good. But being a broker, though, you have the option of shopping at client to a broad range, like Brian was saying, and you have more options to lay that off to, and get your client to the table.
Yep,
So it's been
that's
a
good.
minute since I brokered. I did it for 20 years and then I went into the retail side for the last 10 and I'm back. And I'm looking forward to being able to answer all these questions for you. So
That's great.
work
Well,
with
Thank,
you.
thank you.
Homer, we will get a class scheduled, and thank you for the question,
Sure.
Lori. So good. Any other questions? I know I have you over time, so I want to respect your time. All right, guys, I want to thank you. I want to wish you all a happy holidays. Go get your business plans prepared. Go spend time with your family, and we'll see you on the flip side in 2026. Thank you all.